Hi, everyone, and Happy New Year. My name is Chris Paleologus, and I'm joined today with Tom Meyer Jr. We are both portfolio managers here at Meyer Capital Group. And like many of you that set New Year's resolutions, our company tries to do the same. So at the end of every year, we do a review and set goals for the new year. And one of those goals this year is to try to provide more video content for our clients. And we figured a great place to start is a review of 2022 and some of our expectations and outlook for 2023 as of today. So what just happened in 2022? It was a historic year for a variety of reasons, which we'll discuss more of in a bit. But really, there were a few key factors that led to the market's volatility and declines that we saw across equity and fixed income markets this year. The first of which was the Russia-Ukraine war, which added geopolitical uncertainty, which the markets never like, and an energy supply shock at a time when inflation was a key concern, which touches on our second big factor and probably the main factor being inflation. Inflation was and still is the biggest concern for markets. The Fed got behind the curve, thinking inflation was transitory, and began to implement fiscal and monetary tightening, raising interest rates and reducing their balance sheet at an historic pace. And then finally, from an international perspective, because we are global investors, China's zero COVID policy and the restrictions they implemented to enforce that, along with their slowing housing market and the government's crackdown on Chinese big tech, added to market volatility as it's the world's second largest economy. So those were the main causes. So what were the effects? Tommy's going to touch a little bit about what we saw in the equity and fixed income markets in 2022, and then we'll dive a little bit more into our expectations for 2023.
Thanks, Chris, and thanks again to all the viewers. I really appreciate you checking this video out. So just to start, I'm sure nobody's a stranger to how equity markets have performed this past year due to the rising rate environment Chris touched on. As the Federal Reserve tries to slow the economy down, price compression is happening within stocks as the market tries to price in the rate hikes, the pace of those hikes, and the effects on the economy, like possible recessionary scenarios. So we're actually going to throw up a really nice chart here that kind of puts everything into perspective within the S&P. You'll notice here the big red line, down 20% return in 2022, and this has been the fourth worst year in S&P 500 history since 1950. Tech has clearly been hit the most. Your more aggressive growth companies, investors are not willing to pay premiums to own these stocks as growth potential slows in the near term due to the slowing of the economy. Companies, everybody's familiar with Amazon, Google, Microsoft, things like that. Value companies tend to do better in these environments, but they haven't been immune either. And again, touching on Chris's point about China, that it has not helped at all. Multinational companies have been hurt by this and the zero COVID stance. Somebody like Nike, for example, does so much business in China. And clearly, without your consumers being allowed outside their homes to spend money, it's going to have an impact. So it looks like they're finally letting up, but again, has added to volatility for the markets in 2022. We're going to put another chart up as well to show kind of where the pain has been felt and pretty much everywhere. You'll notice here the NASDAQ 100 down 32%. Something like the Dow Jones has been hit, but not as hard, down almost 7% here. But, looking into, as Chris noted, the global indexes, the EP and the AQUI, these are down 14 and 16% relatively. It's just been, pain has been felt everywhere across the globe. And I wanted to touch again on the Russia-Ukraine war. I think, Chris, I'm sure you agree, this has been our black swan event for this year. The war itself, the sanctions, OPEC cuts, limited supply from the West for oil has caused that energy shock you touched on, which has made the Fed's job even harder. Oil's in everything, right? I mean, transporting goods, stocking shelves, even just creating goods, it's in everything. So again, just making the Fed's job that much harder. But like Chris noted, that is the main driver for the underperformance of the markets as they try to slow the economy and should stop inflation from spiraling. But Chris, again, I know you touched on the Fed falling behind the curve, thinking inflation was transitory. I'm sure everybody in 2021 remembers that Fed and pretty much everybody on the Fed was saying that inflation was transitory. So they had to make up lost ground. And they've implemented the fastest rate hiking cycle in a generation, going from near zero rates to over 4% now. And that brings us to our next chart. We, again, hammers home the point of how fast this cycle has been. You'll notice on the left there, you'll see 2022 clearly more vertical than past years. So again, just puts in perspective how fast the Fed has raised rates to try and fight inflation. So with all that said, bonds have been battered along with equities, and this has led to the worst year for bonds in history. It's been one of the main reasons why this year has been so painful, because your more conservative investments haven't been that typical backstop. So bonds have been in a long bull market, over the past 10 years, maybe yields have reached a point where government bonds can no longer offer characteristics like income and diversification against risky assets, which we've clearly felt. A great stat here is at one point, a staggering 90% of global bond universe was offering a yield less than 1%. And this forced investors to take greater risk in extended credit and even just more equity exposure, which is, just to get a decent return. Because again, you can't beat inflation with less than 1% yields. Along with the equity market, the bond market has tried to price in the rate hikes. And this has forced a bond sell-off to occur. And just to remember at this point, bond prices are inversely correlated with rising rates. As rates go up, bond prices are going to go down. And we do have an inverted yield curve as well, which is a typical recessionary indicator. So we'll see what that brings in this year. But speaking of that, in the bond performance, there are two charts we're also going to show here. And it is a chart of the US 10-year Treasury total return and the Bloomberg US Ag, which is your typical bond index. And you'll note that 2022, right at the bottom there, sticks out like a sore thumb. Again, it's just pain has been felt everywhere this year.
Yeah, I think that chart really touches home what an outlier the bond market's been for 2022, and mainly because of the increases in interest rates that we've seen in the previous chart showing 2022 and the fastest rate hikes tightening cycle in quite some time. So, all of this together has given us basically the only time in history when both the S&P 500 and the 10-year Treasury bond were down more than 10%. You can see that in this graphic here. Just again illustrating what an outlier 2022 was. Of course, rising interest rates have effects on everything, and one of the other main, effects that we've seen is in the mortgage rates and the decline in affordability of the U.S. home prices. The run-up we saw in 2021 was fueled by easy money and low interest rates. Shelter makes up approximately a third of core CPI and 17% of core PCE, which is the Fed's preferred inflation gauge. So they do need the housing market to cool down for inflation to have the possibility of getting to their target. These two charts are pretty astounding to me. We saw the 30-year fixed mortgage rate go from a low of 2.65 to a high of over 7, and it's settled down somewhere around 6.5 currently, which has led to income that's required to afford a medium price home to skyrocket. So affordability has really declined. You can see in 2020. You could basically afford a medium-priced home with a salary of $50,000, and that's more than doubled this year to $112,000. So, the Fed's putting in these interest rate hikes to slow the economy down, and time will tell. And it seems like it's working for right now, but we'll continue to monitor this situation. But that's the doom and gloom of 2022. Not many positives to take away there besides higher yields, maybe for fixed income investors. But looking forward, there were some reasons to be optimistic and things that we think that will benefit investors moving into 2023. So with that, we'll move on to what we expect for equity and fixed income markets in the new year.
All right. So again, new year. So what we are expecting is another 225 basis point rate hikes at the beginning of this year, with the possibility of cuts towards the end of 2023. If inflation dissipates quicker than expected, we could see central banks pause again or even ease the tightening earlier than forecasted. This would support both stock and bonds. But again, of course, if we experience the opposite and inflation remains stickier, the Fed will be, keep their foot on the brake and keep raising rates more than what is anticipated. So we could see further downward pressure on the markets. The uncertainty we think will keep volatility elevated for much of 2023 and at least, the first half. So again, volatility remains. Hopefully we'll get some good inflation data, because I know if anybody's been to even the grocery store, you know how it is. It's been tough on everybody. So, and again, touching on volatility, I know Chris has some good charts that he wants to bring up.
Yeah, so we continue to expect volatility in the new year, and we can kind of see how that's going to play out just from last year, right? So we probably get some weaker than expected inflation data, or softer than expected wage growth, or any kind of tick up in the unemployment. I think the market really takes that as positives moving forward, as a signal for the Fed to kind of ease off of interest rate hikes. Of course, the opposite could be true. The Fed comes out and continues to take a hard stance on inflation, and resets expectations for the market, and that's when you start to see further declines. What's interesting, in 2022, there were actually 63 days where the market traded down more than 1%. And there's only actually been 3 other years since 1938 that had more large down days. And those were 2008, global financial crisis, 2002, off the heels of the tech bubble in 1974. You can see in this chart, basically from 2015 to 2020, the pre-COVID era, volatility was substantially lower than what it's been from 2020 on to this year. So we're in a higher volatility regime, and we expect that to continue. This has led us to incorporate investments that provide downside hedges, like buffered ETFs and lower volatility ETFs. Another factor that we're looking at is growth versus value. Tommy touched on it, and the chart that shows the index returns. Value-oriented indexes were down, still down, but down less than their growth counterparts. However, looking at this chart, we can see that growth stocks still aren't cheap by historic standards. Their valuations have come down substantially, but compared to value, they're still expensive. So we would still continue to favor value versus growth in clients' portfolios, keeping in mind that we'll still have components of growth, just to have a diversified portfolio, but we'll tend to lean towards more value-oriented, higher dividend yielding, cash flow positive companies. Another main driver is going to be earnings, right? So the consensus 12-month forward earnings expectations currently look too high. They've declined by about 4 to 5% from their recent peak. Some positive news, based on that, though, is that the market tends to be forward-looking and prices those in earlier than expected. So, at this chart that's up right now shows that the markets usually have a 6-month lead on earnings per share estimates. So even though earnings have declined and could it be expected to decline more, the markets could have priced a lot of that in already, dampening declines if earnings do fall off a little bit more. But overall, we do expect 2023 to be a better year for 2022. I don't think that's expecting too much. And while we're not necessarily calling for the bottom in equity markets, we do think that the risk versus reward for equities in 2023 has improved, given the declines that we saw last year. Fixed income looks the most attractive that it's looked in years, and yields are anywhere from 4 to 6% for investment grade debt. We've been tilted towards short-term bonds due to their lower interest rate sensitivity and higher yields, given the inverted yield curve Tommy touched on earlier. But looking out this year, this could be an opportunity to begin extending duration and lock in higher yields, as the Fed has the possibility of slowing interest rate hikes or even pausing or cutting in late 2023. Also, from an historical perspective, things look more positive as well. By the end of September 2022, the S&P 500 declined 25% from its peak. Since 1950, following this level of decline, the stock market has tended to be higher a year later. So this is a great chart that shows, when the S&P 500 is down 25% or more, what the returns are 1, 3, 5, and 10 years later. And I like this chart for a couple of reasons. One, it kind of puts some historical context into what happens after market declines, but also kind of shows our longer term viewpoints on staying invested in the market. You can see the 1-year returns still look pretty darn attractive. an average of 21.6%, with the 3, 5, and 10-year returns are, substantially higher. So, being invested during those down periods and when the market's down 25% has historically led to pretty attractive returns in the future. Now, of course, past performance is not indicative of future results, but history is a great, fortune teller maybe for, maybe what to expect in the future. In the short term, forecasts are exceptionally hard to predict correctly, and that's why we try to focus on the long term, specifically clients' long-term goals and objectives. We have them go through a financial roadmap where we factor in 1,000 different trials of market returns to hopefully have them be more comfortable in these types of situations, knowing that we have accounted for these types of negative returns and their plan was still successful. So that ideally helps keep people invested and are able to participate in these longer term returns that we've seen in the chart above. And I know Tommy has a great chart here that illustrates that idea of staying invested and the benefits that come with that.
Yeah, absolutely. Chris, you touched on it. This, again, is probably my favorite chart that I've seen this year. I think it really hammers home the point of, like you touched on history and how we kind of forecast and long-term investing. So I'm going to throw this chart up here and you'll see 3 different lines and we're going to go through this real quick. So the topic of this chart is missing even a few of the market's best days can dramatically impact returns. So in the last 20 plus years, 21 of the 25 worst trading days were within a month of the 25 best trading days. So you'll notice here, everything starts from 1999 and starts with an investment of $1 million. So the top chart here, you'll notice 4.7 million. That's if you miss 0 days. So if you were to stay invested and not try and time the market, from that point on, you would go from 1 million to 4.7 million. Even if you miss the top 10 days, if you'll notice underneath that, you only be left with 2.1 million. And if you missed the top 25 days, you'd only have $33,000 more than you did when you started in 1999. Again, I love this chart. I think it hammers home the point of long-term investing and things like that. So, and just provides great perspective. But again, this doesn't mean we're not cognizant of short-term issues. Like Chris said, we're trying to orient portfolios into more value, shorter duration bonds with higher yields. So we are doing things, but again, we just want to make sure people don't get too emotional and kind of derail their whole long-term objective. Because as humans, we're terrible investors. We'll face it. We're emotional. This is our money and your money, and things like that. And again, it's tough, but again, you have to stay the course. And that's why we try and tell clients and investors how long-term objectives matter and you can get there. And again, just hammering home the point, financial roadmaps that we do offer to all our clients, again, really provides peace of mind to make sure that you can really meet your goals, even during times like this, as Chris noted.
Yeah, it's pretty incredible that 25 days over the course of, over 20 years can make such a, $3.7 million difference.
It's unbelievable.
Yeah. And finally, right, while bear markets hurt, their duration and magnitude tend to be trumped by bull markets. The chart below illustrates this point. So the average bull market increase is 362% and lasts for an average of 6.7 years, while the average bear market decline is down 37% and lasts for an average of 1.2 years. The key for investors here is focusing on their long-term goals and objectives, working with your portfolio manager to design a portfolio with the intention of being able to withstand these bear markets so that you can stay invested and participate in those bull markets is really the key. Of course, if you have any questions, please feel free to reach out to your portfolio manager. And we appreciate you watching the video.
Thanks so much, everyone.